Today is Monday, July 1st. I am Jason Shapiro with Crowd Market Report, and today I get to do an interview, and I'm interviewing Mike Webster, who is the head market strategist at Investors Business Daily. For those who don't know, Investors Business Daily is the group that was started by William O'Neill, who had passed away last year, but is an absolute legend in the world of stock picking. And he developed a system, which you can read about in a lot of places, that he dubs CANSLIM, CANSLIM, each one standing for something. And I love talking about this stuff because CANSLIM is, for the most part, I would argue, a momentum stock trading system. I am not a momentum investor. So I love talking to people that do things that differently than I do. I would argue, and I don't know, I haven't investigated every single stock picking method in the history of the world. But from what I do know, I think that CANSLIM is probably the best stock picking system that there is. You know, you end up playing momentum stocks, you're playing growth stocks, and it doesn't allow you to fight the tape. More importantly, it's not giving you these fundamental things and, hey, you know, this stock's gone from 40 to 30, so we're going to buy it because it's cheap. You know, it doesn't do any of that.
No, that's the opposite of that. That's
exactly. It doesn't fight the tape. It goes with the tape. It is letting the tape. But at the same time, it's also trying to get you into the best growth companies that are growing the fastest based on EPS and all that as well. So it's a great combination of, yes, the company's growing, but B, the stock is starting to reflect that as well.
It's really a blend, and it was something that Bill came up with back in the early 60s when he started out, and he was trying to figure out the market, like how all of us, how you started, how I started, and he did a unique approach that I've copied as far as just looking at what really worked in the market, and he built these things called model books, and they were just, what did a stock look like before it had a huge move? And then he would start at the beginning of it. And, you know, I've got his very first one that he did back in the early 60s, and he gave it to me as a gift. And it's just at the very beginning, what does it look like? And then what does it look like at the top? And he would study that with an open mind. And he was one of the first guys out there who said PEs don't matter, you know, which was sacrilegious back then, you know, because it still is now to a lot of people. And he just looked at the data and said, okay, this doesn't matter. You know, if you only went with the lowest PE in a group, that you're going to miss all these best winners. And he did that for all the different things. So that was the stock part of it. And then he realized that it's really about especially with momentum. And he hated the word momentum. He wouldn't allow you to use that word in-house, but that's what we do is momentum, is we're buying it as it's breaking out of what we call a base, you know, cup with handle or double bottom, what have you, as it's breaking out. And if it works, we're holding it and, you know, adding to it and pyramiding, you know, deliver more thing. And then we have ways of knowing when it might have topped. But a big overriding theme in there is not just the technicals, but the fundamentals. So fundamentals have to be there for us to look at it. Then we look at the chart to make sure it's in position. Then we also, most importantly, we look at the general market. We just have ways of defining what, you know, how deep in the market you should be and how aggressive you should be. And that's just all pure technically based. There's no, you know, economic numbers or anything like that in there. It's just the price and volume of the indices. I stopped using volume. I just use price. That's a big topic. But anyways, yeah, that's CANSLIM. It's taking the fundamentals, the technicals, the market, plus we look at institutional sponsorship, you know, to make sure that the big funds are in there because they're the ones, as you know, who really power the moves. And then, you know, we look at, is there something new involved? That's the N in CANSLIM. And of course, the general market, like I said, that if the market's going down, like it doesn't matter. Growth stocks are not going to work. You know, you can buy them all day long, but it's not going to work. So you have to be in a trending environment for this system to work. But that is part of the system.
Yeah, I mean, so many things I like about all of those ideas. The idea of you start from not a preconceived notion, right?
Mm-hmm.
You start from, let's take a look at the best stocks, which is what Bill O'Neill did, right? And let's see what we could have seen before they became the best stocks. What characteristics did they have that we could have found before they had these big runs, right? That to me is research. You know, people don't like to do that. They like to stick to, you know, this is cheap based on historical levels, therefore it's a buy, and and none of these things have ever been proven. Whereas what he did, I feel like threw all that away and said, let's just wipe the slate clean and let's find what actually has worked. Not what I think has worked, but what actually has worked, and let's go from there.
Well, that was a big part of what he did and what I did with him. And we built the model books together for the time that he was alive, and it was I started doing that started at his firm in '97, but started working directly with him and shared an office with him from 2000, and then we continued working together till he retired. But with those models, he had started in 1962 and had gone forward with those. But it always bothered me. I was like, wow, what about prior to 1962? Would this have worked? And in the 2000 to 2002 timeframe, I was pretty early on recognizing that was like 1929 to 1932. I got deep into that, like before it was a popular thing. Now everyone's like, oh, of course, it's obvious. But at the time, I was knee deep in that, and I was like, wow, I really want to study these stocks back from 1929 to 1932. What did they do, and how did they come out of that in 1935 when the 32 to 35 time frame? And anyways, we looked around for the data and we couldn't find it. The price data wasn't there. So being open-minded, he allowed us to hire a bunch of people, a bunch of temps essentially. They went through the newspapers, the old PDFs from 1880 forward, and just put in the symbol, the high, low, close for each day. And then me and another PM, we studied those from 1880 through to 1962. We were the only people that had ever seen that data. And I studied it to death, man. I love that. It was like a kid in a candy store. And I was scared to death because I'm like, what if all this stuff that we've been preaching, this is how the market works, blah, blah, blah. What if it didn't work back then? And it did. It was the same thing. It was the same patterns, the same thing that happened. There was a few nuances. Market mechanics change over the decades. But besides that, everything was the same. And it goes back to the Livermore. It's fear, greed, hope that forms all the moves. Up and down. And that took us years and years of work, of original research and studying those. And man, we learned so much. It was just a blast.
I just have a hard time believing that if you're focusing on stocks who have the highest earnings per share growth out there, and I know there's more to it than this 2 or 3 things, but has the highest earnings per share growth going on, has strong momentum in the actual stock price, that those aren't going to be the best performing stocks, provided, as you said earlier, we're in a bull market.
Yeah.
But, and this is another thing that I kind of like about this, and please tell me where I'm wrong, but first of all, we're in a bull market most of the time, right?
Yep.
So therefore, these are the things people, one thing that people are negative about sometimes on this whole thing is, oh, well, you'll get killed in a bear market. Okay, we can get into that in a second. But the truth is, we're in a bull market most of the time. So this stuff is going to crush markets during a bull market. So most of the time, it's going to be very good. Now, within this, this is where I might be wrong, but I don't think I am. But if we go into a bear market and these stocks start to underperform, then I believe you would probably be getting out of them anyway, because you're trying to stick in the momentum leader. So if they're no longer a momentum leader, you're probably getting out of it anyway. Am I right about that?
Yeah, you are. And so you said it right at the beginning, like we don't fight the tape. We're only if the market's going up and our stocks are going up. Now, some of us are a little quicker than others. Like I tend to trade a little quicker than Bill would do. But, it's all the variations on it. Like if the thing isn't running up, we use what's called a relative strength line, just the comparison of how the stock is doing versus S&P. And that's a big part of what I do. And I did a bunch of original research on that with the moving averages is something that I put on the RS lines that help out and have some specific rules around that. And basically it forces you out of the stock, because if the stock isn't leading the S&P, outperforming over a period of time, and that's where the moving averages of the relative strength line come into play, that then you need to get rid of it, because by definition, it's not leading. If you're trying to buy leading stocks, growth stocks, you need to buy them while they're trending. Now, the worst time for us is choppy environments like down markets, bear markets. They're relatively easy if you follow the rules. Like if you break your own rules, which we all do, like I do, you screw up and you're like, yeah, that stove is hot, man. Don't do that. But as long as you're following the rules, you don't get that hurt in bear markets. Where you get hurt doing our style are the choppy markets when you get
Right.
false starts and rolls over false starts. And that's frustrating for people who are new to the system. And you just got to stick with it because they work themselves out. Like you said, over time you tend to trend up. Then the big bear market is like you have a quick one like an 87, but then you have the 2000 2002 that everyone remembers, the 07 09, or what happened with COVID, of course the 98 one that happened that was quick, but it was pretty severe. And you go back in time, you can go all the way back to 1929, you can go back to 1907 and so on. If you study history, you realize the bear markets tend to be pretty violent and relatively short compared to the bulls. So, most of the time you're not getting that hurt in the bears because you're getting out pretty quickly, but it is that sideways chop, like a 1966 to 1982 timeframe. That's trickier, just frankly, because it's more chop. There are bulls and bears within a sideways type of market like that, but that's where it's going to be tough.
Yeah, I want to get into a few of those things, but just from what you just said, um, and I preach this all the time. People get sick of hearing me say it, but it's the discipline. The discipline thing is so important, right? I always say you can use any system you want, any process you want, flip a coin, heads, tails, for all I care, right? If you're not going to be disciplined about it, you're going to fail no matter how good the process is, right?
Without a doubt.
And you spoke to that. That's the key. Here's a process that has proven itself very well over time.
Yep.
But if you're not going to be disciplined about it, then you're going to fail,
The
and
only time I get hurt is when I'm breaking rules.
right.
Really, like you can get chopped up a little bit, in sideways. But if you follow the rules, the spirit of the rules, and you're disciplined about it, you don't get hurt. It's just when your ego gets involved, you get a little too heavy, you get carried away with yourself, or you get discouraged. It's all self-sabotage when you're screwing up, really, for the most part, unless, like swing trading can, if you've got tight stops, the way I like to do, you can get chopped up a lot in markets more than you'd want to. But in general, if you're following the rules, not too much bad is going to happen. It's just doing what you did. Like this weekend, I saw that you do your post analysis. That's something that Bill always had us do. Once a year, we do this big post analysis. One time it took me like 4 months, like every day, just going, because I trade a lot, of just really going through and studying all my trades and going, what a freaking idiot. Why did I do that? I knew better than to do that. And it was kind of a reminder. So what I stopped doing was doing that big annual one, because if you're doing it in January for what you did last February, so much time has gone by, you don't really remember the mindset of why you made a certain trade. So now I do like little baby post analysis things, on a regular basis. And I, just as a check, like, what am I doing right? And try to do more of that. What am I doing wrong? Try to do less of that. And always just looking at things objectively and being honest with yourself, because like most people don't realize, you make your own mistakes, right?
So important. Listen to this man, and I've never met him before. All I knew about him actually was that he has great music taste, because but this man is a professional money manager, and listen to these things, because these are the important things to me. Going through your trades, and as you said, with an open mind, right? Yep. There's nothing better than that to me, and it's why I did that video this weekend, was to show people that this is what I do. I've been managing money the same exact way for almost 25 years now. My trades all theoretically look exactly the same, but I still go through this, and really the way I got to the way that I manage money was that I went through 10 years of that and went through, and that's how I developed my process. But just so important, something that people don't do. And you may not do it because it may be a bull market and you'd be making money, doing everything that you're doing anyway, because you're just buying stuff and you're a hero because it's a bull market. But when you lose money, which you will do at a certain point, you will wish that you were doing this, and you can't go back in time, like you said, right? So
Yeah.
keeping a log, keeping some kind of diary, keeping something so that you can go back and analyze what your thought processes were. I just think it's the most important thing that there is.
Yeah, and on top of that, one thing that I did at the last firm that I was at, that I started doing, and it was helpful at the family office when I was running money out here in Austin. I'd email the group, the team, every day, my thoughts on the market, and what that did was it created a record for me, a daily record of, this was my interpretation of today. This is what I'm thinking would be normal for tomorrow. Now, a big part of what Bill taught us was, you don't predict, you interpret. And there's a big difference. You say, like, this would be normal tomorrow, this would be normal next week, and so on. And then you have this record. So if you just email yourself, it's the easiest thing anyone could do. Email yourself after the close every day, after you've done all your work, and just say, this is what I'm thinking. You could email it to a buddy, whatever, to, keep yourself accountable. But then you can go back and look and see, when you started in a tailspin that we all go into, at the beginning, what did it? What was it? Oh, I thought, I got tripped up. I kept on thinking the IWM was going to lead for like 15 million times over the last 3 years. I'm like, okay, here comes IWM. And I started loading up, and they yank it right away. And I'm like, oh, here it goes again. And so now I've realized, okay, every time I try that now, I'm still trying it, but I'm going a little bit smaller because, 3 or 4 years of that,
You get beat up.
old.
No, it's just such, I can't even tell you. It's just such an important and beautiful idea, Like, I have a newsletter now that goes out every week, but really all that newsletter is, as an example, is what I used to write to and I still do, but I wrote it for myself for going for 18 years. And that's all it is. It's my thoughts on and the only reason I'm doing that, like you say, it's not because I'm trying to predict, right? I'm trying to have a record of what I was thinking. So then I can go back and see where I was wrong. And I'm wrong all the freaking time. I mean, we're trying to predict the future, which is, it's a fool's game in a way, right?
Yep.
I always say Nostradamus is not real. You know what I mean? Nobody predicts the future, but I get to go back and I write a lot of stuff in there purposely about macro and about all this, which really doesn't have very much to do with my trading process, right? I'm not a macro trader, right? I'm not going to be doing this because I think the Fed's going to be doing that or any of that. Yeah. But I do write down a lot of my thoughts about that.
I do the same thing.
Just so I can go back and see how wrong I was. Remember how wrong you are.
Yeah, we're the same. Like, macro isn't part of, by definition, the way Bill had the system was, it's price and volume. And like I said, I just do price. But of what the market is really doing, because the whole, it's pricing in what's going to happen in the future, that whole thing. But you can't help it. You're a junkie. I'm a junkie. Like, you've got to know what you think the Fed is going to do. And, I've been saying for a year that I didn't think, Powell was going to cut rates. But CME, Fed Funds Futures, had it priced in. They were going to do all these cuts. It didn't really matter to my process, but I would write that in my notes every day of what I thought and why I thought he wasn't going to do anything. And that's a whole separate discussion. You just read Volcker's book, which is his favorite book. I've read it a few times, and it pretty much tells you he doesn't want to be Arthur Burns, so he's going to wait until it's too long. That's just my freaking opinion. It's worthless. It's absolutely worthless. But I have it for fun.
No, it's a great outlet. Write it down. It's a great outlet. It almost allows you to just get it out, and now you don't have to deal with it when you're trading.
Exactly.
And like I said, I love it because I get to go back and see, sometimes I'm right, sometimes I'm wrong, but it helps remind me that, hey, sometimes you're right and sometimes you're wrong. So I don't be thinking like, you're Mr. Freaking Genius just because we have a tendency to do that, right? We remember when we were right.
Yeah.
And we sort of forget when we were wrong. Whereas if you're keeping a record of this, there is no remembering. And it takes balls because people hate to be wrong.
Yeah.
We know that.
They do.
Right? And when you do that, you will find that you are wrong a lot. So you have to be on, you talk about be honest about this. And you talk about how Bill was like, be honest about this. That to me helps you be honest about it. So it's just so good to me to hear that you do this stuff. And
Oh yeah.
it's even cooler to me to hear that this was big stuff from Bill O'Neill, because I have mucho respect for William O'Neill. So
Oh yeah, we would do, and we had a routine. He had a set routine that he started, and this is something that the folks who follow you could do as well. He had this back from the 1960s, where he was talking to the head at Fidelity, Jerry Sy, I believe his name was. Every Sunday they would talk about the market and talk about ideas. Then he would start doing that with his PMs that he would have, a subset. He typically would have about 10 PMs, and he would do with 2 or 3 of them. And I did that with him from, every Sunday from 2000 until, for about 15 years when he retired. And it was a way of keeping yourself accountable too, because he was talking what he thought about the market, what stocks he liked. And I would, show him my stocks that I like. We would talk about it. We had a NESME list, which is we sold to the institutions, and it was just a buy list. And we had an avoid list, which was for the hedge funds that like to short. And anyways, we would do that together. And it was an accountability thing, because it was like, hey, last week we thought XYZ was going to break out, and it did break out, but it failed. Where did we go wrong? What did we miss? And then he would go back to the base itself, like the cup with handle or double bottom, flat base, you name it, ascending base. And we would go through week by week of that base and see, where did we miss? What were the key items in there? And he had this unique thing that he developed of a week by week analysis, where did it close within the range for the day or for the week, and what did the volume do, and all these different things that we spent, years trying to like codify. It was a project that 2 of us didn't finish, but we got far along. But it was an accountability thing that we would do. Like, okay, and then this one worked. What did we learn from that? What characteristics within that base did it have, so we can get that for the next one? So doing that on a weekend with a group of people, or at least one person, I think is something that folks should do. It will help you out and just keep you honest and in a set routine. We never missed a weekend. It was every weekend.
Essential.
Yeah.
It's essential. People do not, especially newer traders, they don't usually, including me when I was a newer trader, that they don't understand, and you can't understand until you get down the road, how essential that kind of stuff is. I think it certainly helped change my trading life. So that's awesome. So can we get into, and you can tell me as many secrets and keep as many secrets as you want, but let's talk about your process. And I'll just say again, not being a stock trader, not being a momentum trader, but of all the things that I've read, which are many, 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 I think that this is the best stock system there is. And the proof is in the pudding. You look at a lot of these people that have won these, like, whatever investing championships or whatever they call that. And a number of them use this or some derivative of this process. So the proof is in the pudding. You're going to win. How, just like anything else, how you handle the downside is another point, is another thing altogether, right? But if you're in a bull market, you know what I mean? The winners of investing champions are going to be CANSLIM people.
Yeah, they are.
It's almost every year. Okay.
They might, if they're not CANSLIM, they don't. If they don't think they are, they probably are, and they just don't know it. They're a derivative of it.
That's right.
It's because it's growth investing is really what it is. And we call it the IBD methodology, at the firm, but you can call it whatever you want. It is basically what it boils down to is we have certain metrics for earnings, sales, return on equity, and such, just based off of the models. In general, it's the stronger the growth, the better. The more stable the earnings, the better. That's a big part of something that people don't realize. And it's more you realize from an institutional side that institutions want, if it's a mutual fund that's slower, not necessarily a hedge fund that's faster, but a slower one, they want to be able to invest in something that is predictable as any, stock can be from an earnings and a sales standpoint. So the stability of the earnings, as well as how often they're beating their estimates, that's a big deal for us. Acceleration in the earnings and sales, like if you get 2 or 3 quarters of accelerating earnings, just kind of picture it as like an inflection point on an earnings line. That's a huge deal. Then you combine that, assuming you're in a bull market, then you combine that with the base itself. So a base is typically 5 weeks. It can be, a year long. All variations on that. It then gives you a very precise, what we call a pivot point, which is just something that Bill took from, Livermore's pivotal point, that he called it from his book. But it's just an inflection point. And then we have alternative pivots that get you in a little bit sooner. So we have very precise ways of doing it when we're doing it right. Let's picture perfect would be stocks got great fundamentals. Now it forms a cup with handle. And so it's just kind of a U-shaped pattern, then drifts down. That's what we call our handle portion. Then it has, in a perfect world, has one last shakeout with an upside reversal. That's where you start buying it, because now you have defined risk, the low of the upside reversal. As it's working, you're adding more to it. You're pyramiding. Again, it all is really built off of Livermore, of the pyramiding into a winning position. So you're adding to it as it goes through the high of the handle, as it's going up further. And as a general rule, the 50-day moving average is kind of a guardrail that as long as it's staying above that. There's other things, but as a general rule, that will keep you in the bulk of the move. I've got some things that I use with the relative strength line, as I mentioned, that I think are a little bit better than the 50-day. That's just my own thing. It's out there on the web. You can search. I've got, free YouTubes on that. And I call it the quicksand and Grateful Dead rules for it, because I like goofy names for things. And it just keeps you in the trade while the trade is working. And that's, in a nutshell, what we're trying to do. Now, Bill, early on in his career, would hold things for a longer period of time. At one point he was holding some things for, multi-years. That changed, in the 80s going forward. And it was a shorter time period that he would hold for, more in, measured in months rather than years. But sometimes it would be shorter for him, just really depended. So, that's what we do, and everyone should pick out of the CANSLIM, the IBD methodology, what works for you. And you're a market wizard. You're in the Market Wizard books, my favorite series. Cannot tell you how many times I've listened to those over and over and over and over again. I've got them on Audible. I listened to it, re-listened to your thing over the weekend. Just great story. Love it. I want to talk to you about you being in the whole Buddhist thing, because that's really interesting to me. We could talk about that off air sometime, but I think people should read those books, the entire series, and pick and choose from the different folks. This meshes with my personality. This doesn't. So I'm going to drop this and I'm going to use this, because that's the hardest part, is finding the system that works with your personality. You found what works for you and how you're wired. I finally found my way. I took forever trying to be Bill, and I'm not Bill, and I'll never be
Amen,
Bill.
man. Amen.
Now it's fucking hard, man. Figure
no, I mean, I have this conversation again with the people that sub to our stuff all the time. It's like, don't copy trade me, man. It's not a good idea, and they're like, oh, well, I've seen your returns. If I can get your returns, then I'd be happy. I'm like, yeah, but you're not going to, because you're not me. You're going to fuck it up in ways that are going to be probably. And I go, and by the way, be better than me.
Yeah.
Because you have the advantage of, I do what I do. Okay. But you have the advantage of, you can take things from what I do. And now, like you say, go read all the Market Wizards books and take other things from what other people do, right? That fit your person, and put them all together and be better than me.
Exactly.
Don't be me, be better than me. Being me ain't going to work anyway. Okay.
Yep.
Because you don't know the process. You know what I mean? Like, you haven't lived this process for 20 something years like I have. You know what I mean? So there's a million reasons why that doesn't work. But it's just like you say, go through this stuff and find what makes sense to you and find what fits who you are. And then from there, now build something that works doing that. I think that makes so much sense.
Absolutely. And that was so hard for me to come to a realization, because I idolize Bill, still do. And he was the only guy that I ever wanted to work for. Like, it was my dream. Like, it was, I sent you guys the kind of a little description of, like, I don't know if you had a chance to read it, but my story. And essentially I read Bill's book, this version of it. This was actually the gift that my parents gave me for Christmas in 1995. When I read it, I was like, I have to work for this guy.
Can you show the book again? Because I think everybody could read that.
Yeah. This is
I don't care if you are a momentum stock investor or not, you should read this book.
That's the old version. Now you'll see it in this one. I was blessed to get to work on that version with him, and he was nice enough to quote me in there or put me in there a little bit. But the point is, I read that and it just meshed with my personality. I'm like, this is who I need to work for. There was no plan B. There was none. I was like, got to go work for him. I started off in the research department, took a pay cut. I was working at T. Rowe Price, a mutual fund company, and left it to work in his research department. First day on the job, the guy walks me around to everyone, for 40 different people. Here's our new peon. It just like, it got worse from there, and eventually, I met with him and I showed him my trades. I walked up to him. I'm like, Bill, I want to be a PM for you. And he's like, well, mark up your trades. I have a whole binder, still have it with all my trades, and brought it into him. And he beat me up for like an hour and a half. Like, he's just like, you did this wrong. You did this wrong. You did this wrong. And I thought I was a genius at the time, and you know how it is. Like, you think you're a genius until you get your head handed to you.
Yeah.
Yeah. And then, so I went back to the drawing board and I just improved and improved. And then, in late 99, he gave me money to run, and, started that in early 2000. And, but anyways, the point was.
Great time to get involved in momentum investing, by the way.
Say again?
Great time to get involved in momentum investing, early 2000.
Yeah. Well.
And I mean that seriously, because why not get involved right when it was the hardest to possibly do it? That's where you're going to learn the most lessons, I think.
Yeah. So from 97 to the end of 99, that was a unique time frame, that anyone should go back and study. And it was very similar to 1927 and 1929. It was almost identical to exactly what happened there. In 1929 to 1932 was identical to 2000 to 2002. And I remember, and it was like April of 2000. And on a Sunday night call to Bill, I was like, I really think this is, or no, it's actually March. I said, I think this is reminiscent of 1929, and he told me, he's like, Mike, don't go tell anybody that, you're going to spook the market. Like, who cared what I was a 20-something-year-old kid. No one even knew who I was. Right. Would have cared. But that was his mindset, was, you don't want to spook the market type of thing. And
wait, I want to stop you there.
Yeah.
Because first of all, I want to get back to what we were saying before, but even before I can do that, now that you said that, 27 to 29 was very similar to 97 to 99.
Oh, yeah.
Okay, great. People want to say that right now is that too. So being a person that studied this stuff, please tell me what you think about that thing, because I personally think that's horseshit. But what the hell do I know? But can you please tell me what you think about that and why?
Yeah. So I've studied the market. I love this stuff, right? So I've studied it and kind of broke it down into time frames. So like 1900 to like in the 1920 range is generally a sideways market, kind of like what happened from 66 to 82. And that's the worst. That's the sideways, up and down, bull market, bear market, bull market, bear market, not really making any fresh headway. The late 20s, really like 25 to 29, that was more like 1995 to 2000. The 2000 to 2002 was like the 1929 to 1932. And then you had like the 03 was just like what happened in 32 to 35. And so people should really go back and study long-term charts, like monthly charts or quarterly charts of what the Dow did from 1900 to 2000. And really understand that we're not in that phase yet. We're not in that runaway, what I call a bubble market, because if anything, maybe we're like 1995. There is the euphoria around the AI thing, and I think people are equating that to, you were in the 90s too. You remember that the whole thing of everyone and their brother and the shoe shine salesman, all that type of thing. Yeah, like everyone is like, I remember people saying, oh, Dell is on sale. Just buy the dip, buy the dip, buy the dip. It's on sale. Well, you know what? In 2000, and in March of 2000, that's when we topped, like March 10th, March 14th of 2000. Then we came back down. We had one last gasp in June of 2000, and we went up, and then we really rolled. And people should go back and study that and study how that's so different than what we've had recently. Like the COVID bear was very unique. The The 0709 was very unique too. That whole time frame was different than the 73 to 74 grind lower bear market, which was, people don't realize how bad 73, 74 was. I mean, there's so much in the history, but the short version is no, I don't think we're there. I don't think we're anywhere near that time frame. Will we get there? Maybe. I don't know. We take it day by day, but right now we're not there. We're just in a normal bull market. This is not a bubble market. When we get to a bubble market, you'll know it, because everyone and
That's
their brother will be
exactly right.
quitting their job to go day trade or what have you.
That's exactly
You know.
what I say to people, man. Like, well, when is it going to be? I go, you'll know, dude. Believe
Oh
me.
yeah.
I've been through a few of them because I lived in Asia when Asia went through it too in the early 90s. You'll know, believe me.
Oh yeah. Yeah.
And I don't see, I did a video on it just a couple of weeks ago, 2-3 weeks ago, saying why I didn't think this was this, because these are the things that happen. And I don't see any of those things happening.
Not
I
yet.
see more people trying to say that it's a bubble than I see people, like you say, quitting their jobs and trading these things, right? That's
Yeah.
not what the top of a bubble looks like. I'm not saying personally that the stock market can't go down,
Oh,
but I'm just saying it's not that. Okay. It could
yeah.
go down for something else, could happen, whatever the hell could happen, right? But this is not that. That's all I'm saying.
Exactly. And you will have normal bear markets. You'll have normal intermediate corrections. Intermediate corrections are painful for growth
Yes.
investors.
Yes.
We kind of define like an intermediate correction 8 to 12% off your highs.
Right.
Well, that means your average growth stock is going to be 20%, 25% off their highs.
Yes.
So if you haven't taken action and raised cash, you get hurt really bad. So
Yeah.
it'll feel like the bubble burst, but no. It's different, and people should study, like you mentioned Hong Kong. You should go and study those runs that it had. You should study Japan. And because that was, another thing that I'd mentioned to him back in 2000. I'm like, at the time, we didn't have the 1929 data in our database. I was able to get it through TradeStation, but I couldn't get it through our database. So I had the Nikkei. And I was like, oh, and I think it's like the Nikkei when that topped in the 80s. And so it was, history just repeats itself. It goes through these cycles. You'll have this period where it will really accelerate. Like, people should study post the double bottom that happened in 98, that run up to March of 2000. So from October 98 through to March of 2000, study that. That's a bubble. Go back and study 28 to 29. That's a bubble. When you see something like that, these parabolic moves, then ride that sucker, man, because ride it till the end. Because I was able to, capitalize on that. Anyone who was, I don't want to say me, anyone who knew the system was able to capitalize on that. And of course, you got hurt from 2000 to 2002, but that was more getting in and then getting right back out. And what we learned from that the hard way was, when you're in a bear market and you're getting back in, get back in smaller, because we were still in that mindset of pushing it. And so it would chop you up. But we were out most of the time from 2000 to 2002, but we still got hurt, but just not in the same way as if we would have held the whole thing, because we have these things called fall of your days, which was a way that Bill devised of getting in the market. And you can look in the book and it's in there. And then that's kind of your green light to start buying again. And we would just buy, and he would call us racehorses because we're all aggressive traders. And, you just get it, you stick out your neck a little too far, you get it, chopped off, and then you go back to the drawing board. And that happens in bear markets. So what I could say to people is, if you're underneath the 200-day moving average on the SPY or NASDAQ, be freaking careful, man. Be small, then
such a simple rule right there.
Right. It's that simple.
Keep it simple. I just want to go back. I love hearing you talk, but I just want to try to keep the train of thought. So we talked about the why. Okay.
Mm-hmm.
Why do you want to get in the stock? EPS growth is good, et cetera, et cetera. We kind of talked about the when. Okay. There's the why. Okay. This is why. When? Well, after it forms a base, and I'm sure if people want to get into the detail, they should read that book or look at your YouTube videos. But there's the when. And in general, it's like, okay, it's formed a base, a cup and handle, whatever the hell you want to call it. And now it's breaking out. I love the fact that you say, I don't do this with my trading, probably because I'm just too much of a chicken shit, but I don't pyramid into things. But
Okay.
you're pyramiding in. But when you're pyramiding in is when it's working. So I always tell people, like, if you want to make a trade because you believe something, that's all fine. Whatever reason you believe, I don't care. But the market should be confirming that what you're saying is right first. Don't fight the tape. And that's what you're doing. It's confirming that you're right. So you're pyramiding in, right?
Yep.
So that's the win.
We never, ever,
And
ever
to
average
losers.
down.
Right.
Ever. Under
Right.
any circumstance
Right.
do
Great.
you average down.
So now my next question is, we got the why, we
Mhm.
kind of got the win. And then the last one is, now what? And what I mean by that is, so we got your entry. Okay. This is the stock we're looking at because of the EPS and all that stuff. We
Mhm.
got the technical thing that we like. Here's the space, and here it is breaking out of the space or whatever. Now what? Now, first of all, we have to size the position, right?
Yep.
So how do you go about sizing your positions?
So that's a big question and an important question. And one of the things of why I said that I'm not Bill O'Neill and I'll never be, how he made his fortune was pyramiding all in on one name. And he did that in 62 with Syntex. Well, before that, he did it with Chrysler. Then right after the Cuban Missile Crisis, then he did it with Syntex, which was the birth control pill. He did it again with Pick and Save, which turned into Big Lots. He did it with Price Company, which turned into Costco. Did it with Amgen. He did it with AOL and Schwab in the 90s. Did it with eBay. And so that's how we were wired, is to go all in. And, I did that too. And
What do you mean by all in?
he went all the frick
You have
in.
$1 million in your account. You see
2
this stock,
million.
it does
He
all
would
your
go,
shit.
he would go 2 million.
But then how could you do more than one stock?
That's why I'm not Bill. He would do it, and he would keep pyramiding in until he was all in. And the CFO at the firm would always say, you know what, Bill would be like asking him for like change from the cushions in the couch. Like, obviously he was joking, but Bill would want all the margin, because when he had a name that he wanted to go in, and it wasn't, he didn't do it all at once. It was slowly over time, but
Right.
he would do this force feed method of, he would have multiple stocks. He would tend to do 5 to 8 stocks and then whittle it down. The ones that are working, he would take the money from the ones that weren't working. They're either lagging or just, we do a max stop loss at 7 or 8%. If that's triggering, then he would take that money and he put it into the one that is working.
Hold on. Cut your weeds.
Yep.
Water your roses.
Exactly.
Which is the opposite of what most people do. But anyway, go ahead. So he'd cut his weeds and he'd water his roses. Go ahead.
So he would do that. And then he had the ability to never freeze up and never blow up, because he would then get out as the stock was starting to roll over. He would, or if it went into a climax top, which those don't happen very often, but it did in the late 90s, that he would start gradually getting out of the stock, because he would sell. He didn't do LIFO or FIFO or average cost. He would do highest cost. And that was his way of keeping a distance from his cushion, really, from where the stock is trading at and where his cost basis was. And so he was always wanting a big enough cushion that they couldn't take that away from him with a gap down or really severe gap down. He was the best at that. No one, I've traded with a lot of other PMs that all wanted to be Bill. No one has been able to do what Bill did. And
so how do you handle the sizing? Is there a formula, or is it a feel, or?
I do what's sacrilegious to Bill. I do a shotgun approach. So he would do 5 to 8. He would say you never want to do more than that. I like doing lots of tiny baby positions. Like, they could be 2.5% positions. Then the ones that are working, I'll add to them. I have no problem owning 40 stocks at first and then whittling it down to 5 or 8 stocks. Whereas he would start with 5 or 8 stocks and whittle it down to 1.
You're not whittling it down. The market is whittling it down for you, because the ones that aren't working, you're cutting out of.
Exactly. And I find it, doing a little baby positions, and they don't work out, just out they go, and they don't hurt that much. You got a big position, it hurts. And I can tell you the last time that I did real size with his count, and there's not a lot of things I can talk about my time there, but this one has been made public when I used to teach seminars with him, that I can say it. Well, we were trading Google shortly after it went public and Apple at the same time. And everyone at the firm was 200% long those two stocks. So I happen to have 120% of my capital in Apple and 80% in Google. Other guys would have 120% in Google, 80% in Apple. Every night, and we made a ton of money because we got out of them okay. We made a lot, but every night I went to bed going, I thought Steve Jobs was going to die in a plane crash and we were going to be wiped out. And I was going to be wiped out and the firm was going to be wiped out. And the amount of stress that I went through did not allow me to trade that size properly because every time I had to wiggle and wobble, I go, no, here it comes. Right. We're going to roll over. I'd oversell, then it would come back, and then I'd have to overbuy to get back my position, so I could be a stud like all the other guys.
Right.
And then you do all that over again. Yeah, it's the psychology, and we're competitive and all that stuff.
Right.
In the end, I was like, you know what? 25% in one stock is crazy enough.
Yes.
And that's more than you need. And on the street, that's crazy. Like, 10% position is big.
Yes.
And what we did was just almost, I don't want to say reckless because Bill was able to get away with it, but he never had a blow up, a serious blow up. We'd get gap downs, but he never blew up. And, I just can't, I don't want to put myself in that position where at night I'm going, oh my God, I hope something bad doesn't happen to the CEO. So I
fell down to the sleeping point, they say.
Yep.
So true. Size based on, again, who you are and how comfortable you are, it sounds like is what you're saying. Mm-hmm. It's got to be an individual thing, how much risk you're willing to accept. All right. So we've got our position on, it met all our criteria. We're sizing in how we want. I believe that what you guys do, or at least Bill O'Neill likes to say, is 7% loss. If it goes down 7% from that breakout entry level, he stops out. Is that correct?
Yeah, at the most, he would keep his average cost or average loss at 3 to 4%. That was his target, but 7 or 8% was the max.
So if it breaks out and you're buying this breakout, this cup and handle breakout, and then it fails, you just get out.
Yeah, but you got to be willing to buy it right back if it sets back up, which is very, very hard for people to do psychologically.
Very hard.
I wired myself where that's not a problem at all. It's a problem for people to follow me with that. So like, when I'm recommending stuff for our service and I put something on and then I take it off and I put it back on, it trips people up because they're like, wait, you just sold that yesterday. Why are you buying it back 2 days later?
Yeah.
If it,
I see that all the time.
If
I
it's
trade
right,
too a lot. I'll lose 2 times. I'll lose 3 times. And then people are like, shit, man, this trade sucks. Well, and then of course that's when it'll work, which is why people can't copy trade very successfully. But yeah, I say it all the time. So anyway, you're stopping out and then you'll re-enter or whatever if it again meets the criteria.
Yeah.
And now, so that's the stop. Now let's talk about the exit. What are you determining your exits on?
So one of the things that he had, which was I think a really good basic concept, was to try to take most of your profits when you're up a decent amount. He would call a decent amount up 20% on the stock. Sometimes 20% is more than the stock is going to run before it's going to base out. Sometimes it's only 12 or 15% before it has to have a natural correction in there. And that's the tricky part because you don't know, is it going to run 12, 15, 20, 25%? There's clues in the chart that you can look for, but there's nothing foolproof. But a lot of it is locking in a lot of those smaller gains to try to get the bigger one that you think is going to be the model book move. To exit on those, what he would use would be some offensive sell signals like a climax top, but there's very precise rules and it's in the book. It's like a $10 book or something like that. That maybe it's $15, I don't know, but they don't happen very often. So most of the time it's defensive. So it's like breaking down trends, or his thing would be a 10-week moving average, which is essentially the same thing as a 50-day. That works really well. What I have developed to hold stocks is using moving averages around the relative strength line, as I mentioned earlier. And again, you can just, YouTube that, and you can just Mike Webster, quicksand, Grateful Dead, any of those terms, and it'll show up the video and I'll walk through the rules for that. But it's essentially 3 different sell rules on the way out. When one triggers, you sell some of your position. When the next thing triggers, you sell a little bit more. And then the last thing, out it goes. Because, there's no perfect sell signal. So it's a gradual stepping out of it. And that's just something I developed to try to hold on to winners. And it's just out of frustration, really, is me mishandling things along the way, just going, God, why did I have this problem where I start selling, and let's say I have 1,000 shares, let's just call it a round number. And I'm like, oh, I'm going to sell 100 shares. And then it goes lower. I'm like, shoot, I should have sold more. Now I got to sell another 200. And then I sell, oh, wow. And it goes lower. Before you know it, I'm down to only owning 100 shares when all I wanted to do was trim. So I had to come up with rules to keep me in the stock to solve my personal problem of overselling defensively, because I'm always worried. I'm always worried the stock is going to blow up on me. The stock is going to roll over on me. That's just how I'm wired. I had to figure out that that's what my psyche is. And so this was a way to counteract my psyche of saying, okay, what do I really know? Is this stock a leader? How do I know it's a leader? It's a leader if it's a relative strength. So relative to the S&P, it's still trending up. Well, how do I know it's still trending up? And that's where I came up with the moving averages. And I've laid them all out there. It doesn't cost anything. You can just, see what I do, and you can tweak it. Like, anyone can, look at it and go, oh no, those are too tight. I want to use longer term moving averages. Then use them, but test it out first so you understand the tighter the moving average, the more you're going to get kicked out, but the better prices you're going to get. The longer term moving average, the more you're going to give off the top, but the less times you're going to get chopped up and get out on a false signal. So that's why I blend a couple of them and have this 3-step process. It works for me, but I'm always trying to improve it,
Sure. It's all a trade-off because there is no perfect signal.
No.
You're playing in a uncertain future.
Yep.
So you don't know. You know what I mean? If you knew, you'd know exactly what to do, right? So you have to
Exactly.
play it in an uncertain future. Cool. I like it. So why don't we talk about, and then I'll let you go. What are we doing now?
Right now we just
Have you been, I assume that you've been involved. If you're talking about a stock that is going ballistic on an EPS growth rate and ballistic on a, on a momentum, there's only one stock to talk about. Were you involved in that? Were you involved in that bad boy?
Yeah, I have a position in NVIDIA. I think it needs to pause here.
Yeah.
Had a little upside reversal today and had a downside reversal the other day.
Mm-hmm.
Based on history.
Did you catch it good? Like back in the, when it broke out a couple of years ago or whatever it was, a year?
Off and on with that. I did not get that big move in there. That was, I was in some other stocks during that time, but during this move, I'm happy with what I was able to do with it. At this point, it's a small position because, I think we're rotating into software names out of chips. So I'm moving into that space, but I still have a position in NVIDIA. But I think at this point, based on not what I think, but based on what the market is doing, it looks like it's shifting over from chips into software. So I just study where the puck is going, and I'm building positions over in that space. You can think like I've got a position in IGV for, as far as the software, and CrowdStrike is one of the specific names that I'm playing right now. And if it doesn't work out, I'll just back out of it.
Sure.
But, NVIDIA, what I don't like about it is everyone and their brother is talking about it. And that is a little reminiscent. You asked about, was it like 99? When everyone is talking about the same stock, it bothers me.
At this point.
It's
except that the way I've seen it is everyone's talking about it, but nobody freaking owns it. I mean, clearly somebody owns it.
Oh,
but
yeah.
I've seen in the last, it's not so much in the last few months, but up until the last few months, I saw more people talking about shorting NVIDIA than I saw people talking about buying NVIDIA.
Yeah, no, that's, you never short. Well, we have a specific, I'm not good at shorting. I'm terrible at shorting because the boogeyman's around the corner and the stock is going to get acquired is what I always think. But you don't short a stock when it's in an uptrend. You short, there's a specific way that Bill designed to short, and it's something that we did with a void list that we give out that we sold to institutions, and it's basically a head and shoulders top or a late stage base breakout failure. Those are the setups that you want after it's done. So you're giving a lot off the top, and people want it to be. They want to be the hero and short it on the top day. Well, that's freaking crazy, man. You can't do. No one.
I know a guy who's actually been really good at shorting. He always tells me I wouldn't short anything until it's down 30%.
Oh yeah, that's about right. Yeah, 25, 30%. Because when you do that, if it's proven that now it's in a downtrend and then it rallies up and that rally starts to fade, that's where you have an exit, right? Because if the rally starts to fade, you have your stop at the top of that rally, if you're going to short it. I don't do a good job at shorting, so I don't do much shorting, frankly. I'll short I think I do a fairly good job at an index level. So I will use inverse ETFs to short the market because I don't have that boogeyman that I have to worry about of getting the stock getting bought out the next day, because you can't buy 500, if you're shorting SPY or shorting the Qs, you're not going to worry about the Qs getting bought out tomorrow. So that's not a possibility. So that's why I don't like shorting individual stocks. But that's just me. Bill is fine shorting individual stocks because he did a good job at it. I don't.
Fair enough. You mentioned that you want to be involved with these stocks heavily in a bull market.
Yep.
So can you tell me, what is a bull market? What makes you decide that it's a bull market? Are there any indicators, or is it a feeling, or is it just observing?
No, it's not a feeling at all. So one of the things that I developed with two other guys, Justin and that you did the podcast with, and Charles Harris, an old PM that's still over at O'Neill. We developed this thing called the market school rules, IBD market school rules, and they are all 100% black and white, because that drove me crazy of market calls based off of what the Fed was doing, what the economy was doing, what the feel was, what the bull bear was doing, what the VIX was doing, put to call all that crap. Frankly, in my opinion, just looking at what the index is doing, and we just narrowed it down to just the NASDAQ, because NASDAQ tends to correlate with growth stocks better, and it's just price and volume action, and it's defined, and we have a course on it. I'm not trying to push anything. I don't get any money if we sell it. It's called the Market School home study course. People can get it, and it has black and white rules. If this happens, then the count, we just have a count from 0 to +7, that it dictates our speed limit. So think of, like Sammy Hagar, like, I can't drive 55. Like, you have a speed limit involved based on what the market is doing, and that'll keep you out of the market. So when you're at 0, you're supposed to be out of the market. When you're at a +7, you can be in and go in on margin. And we're at a +7 right now. And so that's, that's where you, well, I should pull it up to make sure, but that's where we're essentially, it's based around the 21-day exponential is a big part. The 50-day simple is a big part of it. And when you're trending above it, we have very specific rules on when this happens, you do this, and it lowers the count by X amount or raises it by X amount. And we just back tested it. Is it perfect? No, but it helps keep us on track. And the reason why we came up with it is Bill started getting involved with the PMs and started telling us how deep in the market we could be. And that didn't work out, because for a while, and this was after the 07, 09 timeframe, it really kind of changed him. We didn't really we did well from the 07, 09, because that was a pretty cookie cutter bear market in a lot of ways, in that it stayed down and didn't give you a lot of false signals. It was a lot easier than the 2000 to 2002, because you had a lot of quick rallies, whereas that one was just like straight down, and that was the only time in my life that I spent 6 months not trading at all. And I came in every day with a watch list, and I had all my stocks. If the market turns, I'm going to buy XYZ. So it wasn't like I went on vacation. I was just waiting for a fat pitch. And I thought it was the best trading I ever did, just by not trading. It was really hard because I'm a junkie.
Man. That all comes down to discipline. That whole thing is discipline. And it's so hard. It's so hard, but so important, because you're a upside momentum trader. Yeah. And the market was going down. And so by not trading, you didn't lose any money, which is so important, to not lose money when it's not your time, because that way, when it is your time, you'll be making money, and you won't be making money back. You'll be making money.
Yeah. And people
get such an important concept. I can't even.
People get frustrated with that, Jason.
I know.
We used to teach a bunch of seminars. I would go around the country, and I tied with Bill until he stopped wanting to travel, and then I would taught with another PM, the same guy that I did, Charles, that I did the market school with. And I remember during that time frame being asked at a live event, that what I was doing, and I said I've been in cash for 6 months, and they were like, "Well, we paid," and it was like $3,000 or something to come.
Right, right,
We paid $3,000 to hear what to do, and there's a bull market everywhere, blah blah blah, that whole thing.
right, right.
And I'm like, look, like
You're
I'm
missing the point,
super
man.
happy that we're not trading, but they were not happy. People don't want to hear when
No,
to,
I know. I mean, look, to your point, I run a very specific thing. It's the same thing, right?
yeah,
And my thing is designed. Well, it's not designed. It's designed to do what I like and what I do in my personality. But what it does is, because it's very counter trend, it offers negative correlation to
mhm,
trend following and stuff. And so people give me money for that, right? If they have a fund of funds and they're in
to
trend,
balance out against guys like me.
right?
Yeah,
Exactly. And
yeah,
that's how you build wealth over time. You have a bunch of non-correlated things, right?
yep.
So earlier this year, I basically had no trades,
That's
and which
great.
is the first time that happened for me. I want to say ever. Okay, in 20 plus years of doing this, I had no trades for like 3 months. It's very hard, but I
Yeah.
have people. It's like you say. Suddenly, I have this newsletter, and people are like paying for this newsletter, and they're like, "What the fuck? Like, what am I paying for?" Right? But as
Well,
it
you're
turned,
giving out probably the best information you'll ever give out.
yes, but as it turned out, it's just like you say. Trend following for those 3 months crushed it,
Yeah.
and my return was zero.
But for your
which is a
strategy, that's
which is a home
perfect.
run. No, it's a home run.
Yeah.
You know, usually if trend following makes 10%, whatever, I'll lose two or three.
Yeah.
And then when trend following loses 10%, I'll make 12, right? Something like that. And
Gotcha.
that's all great. But if I can be flat, so anyway, I'm not here to
Well, that's a good, sounds like
to
a
your
grand
point,
slam, not a home
to your
run.
point that's the game. That's really the game over time. If you cannot lose money when it ain't your time,
Yep.
right? It does. It's just like making money. It doesn't feel like it, but over the long period of time, that is making money because now you don't have to make back losses. I
Well,
and it's very
exactly.
hard to do. Like you say, we're all junkies. I
Yeah.
have people tell me that all the time. Oh, I'm a market junkie. I'm like, everybody's a freaking market junkie. I have people tell me that all the time. Oh, I want to be a trader. Why? Oh, because I love the markets. I'm like, we all love the markets. That everybody loves the markets. Okay.
Yep.
It's like saying I love drinking. I want to be an alcoholic. Like, you know what I mean? It's a vice. It's gambling. Everybody loves this shit, right? But that's not
Yep.
enough. You know what I mean? Loving it means that you actually want to succeed at it. And to actually succeed at it, you have to be able to be disciplined enough to do exactly what you're talking about, I think, anyway.
Yeah. And what people need to do is really study history, right? Because if you look at, let's say you're a trend follower like me, you'll recognize that if you've got a trending system, you're not buying on the bottom ever because that's not part of a trend. You've got to wait for some sort of
By
trend.
definition, yeah.
Everyone's got their way, right? We have our way. Maybe it's better than someone else. Maybe it's not. Maybe someone else has a better way of getting in. But you have an entry signal. You have an exit signal. If you're a trend follower, you're not getting in at the bottom. You're not getting out at the top. You're just getting that. The heart of the watermelon is your goal. So the way to outperform the market over time is to be staying out during those downturns or to be lighter invested during those downturns. That is the most important part. So if people are watching and they don't remember anything, when you're underneath the 200-day, just stay away, stay tiny, like trade 1% of your account. If you're a junkie, trade. There was a time where we were underneath the 200-day. We were all wanting to trade. Bill say, okay, you can trade, but you can only trade 1% of the account. And that was a good learning lesson for all of us because we traded that 1%. And it's amazing how much you can lose over time. Just 1%, like doesn't work. Well, you don't lose that much, but psychologically, it was able to reinforce to us that, like, you know what? Don't trade. And you're better off if you're in a downtrend, not trading at all, really.
Awesome, man. Really. I wish I met Bill and Neil because it's like I'm just as guilty as anyone else. Does he give, things in his book and all that of things that work in the market? Sure. But more importantly, listen to what his psychology is of all the things that you have told about him, right? That's even more important than somebody because nobody's going to be able to give it to you over time. Oh, the S&P is going to go up here, the S&P is going to go down here, right? But what you can learn from them, I think, is mindset. And all
Yeah.
these mindsets that you have talked about that Bill O'Neill apparently had.
Yeah. He was
That's
the
what it's all
best
about.
ever.
That's what this is about. This discipline and this mindset of research and this mindset of keeping an open mind and this mindset of understanding risk. That's where no one wants to hear this. Everybody wants to hear you make money by predicting the future. But
Oh, if we ever predicted at the firm, oh my God, he would have shot
yeah,
us.
right.
Like that was predicting is a dirty word, man.
Yes, no, that's what people think though. They think that you're going to make money by predicting the future. And I constantly preach this. That's not how you're going to make money. Okay. You're going to make money by having this mindset of risk control and of process and all this. And it's just such a pleasure to hear that Bill O'Neill felt the same exact way. Although it's not a surprise because every successful trader that I've ever known has that exact same mindset, which quite frankly is why I have it, because I'm just copying them. I'll try to listen to what the best did and try very hard to do that.
Well, that's why I said at the beginning, and I'm serious. Like, I'm not, I say this all the time. To anyone who will listen, read all of the entire Markets Wizard series over and over and over again. Your chapter, everyone's chapter, and really try to find what you can relate to. I mean, it's really that simple. Is fine. Okay, Jason does this, Bill did this, and David did that, and all the different folks in there. Linda did this, and just pick and choose. Make sure that you're going with the grain. Like never fight yourself. And if you're thinking about your trades at night, boy, man, you got some problems because your position sizing is wrong. If you're thinking, geez, I can't wait to wake up to buy more of XYZ, or geez, I've got so much of this. What happens if this happens? You need to dial it back. You need to adjust things because you want to be comfortable. This should be fun. I always tell people, like, don't make this out to be something hard. It should be fun. And so if it's hard and not fun, take your account. Let's say you've got whatever it is. You've got $10,000, you got $100 million, anything in between. Dial that back down. Just take 5 or 10% of that money, start trading that, put the other amount into CDs, into cash, and trade with that. Try to learn and try to enjoy yourself. Try to do the right trades. Then, as you're proving yourself, slowly take that money out of the cash account and slowly, not all at once, slowly put it into your trading account. Keep it fun because, otherwise you can just give your money to someone else to trade. If you're doing this yourself, it should be an enjoyable thing. Are you going to be stressed out at times? Yeah. Are you going to be excited at times? Yeah. But try to dial it back. Like, I never saw Bill, one of the last things I guess I could say, because I know we've gone a long time and you probably want to go hang with your family, but I never saw how he did in the market on his face. Like you would never know. I would know that, man, he just got killed today, or he just killed it today. I would know, but you can never read it on his face. And I've always tried to mimic that because you see that people are just high-fiving, oh, I'm doing great, blah, 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 or they're down in the dumps. Just try to keep it even keel, because there's going to be ups and downs in the market and you're going to think you're a superstar. You're not. You're going to think you're the worst trader in the world. You're not. You're somewhere in between, and just keep it fun.
Awesome. I didn't know what to expect coming into this, other than I thought you would probably be a cool guy because, like I say, I thought your music choices are just great. And then when I see you show up on my screen and you're kind of a hippie, then I knew I'd be good. But awesome, the lessons that you have talked about on here. Again, I tried to push the idea of, what gets you in, what gets you out, and what gets you stopped and all that shit. And we talked a little bit about that, and people can look more into that by going into Bill's book or going onto your, but the other lessons that you speak of are just so important. People that are listening to this that want to learn, listen to these lessons that he is speaking because they are the truth.
Well, thank you. And anyone who wants to listen, I don't like pushing things on every Friday after the close, few minutes after the close, we do a free, it's on YouTube, podcast, webinar, whatever you want to call it. Allie and I, a colleague at the firm, and we go through what I think of the market, my interpretation of the market. It's free. Check it out, see if you like it.
Where is that?
That's you can just go on our website, or you can go on to
IBD website.
IBDsinvestors.com, or you can go on to our YouTube channel, and it's every Friday. It's called The Stock Market Today. It's about an hour long. It's free. I try to keep it fun. Yeah, and if it works for you, we've got other stuff, but I don't like pushing things. It's just, if our stuff works for you, great, and if it doesn't, find something that works for you.
Awesome, Mike. I appreciate your time. We went a long time. I could go longer. We didn't
Thanks.
even
If you're
talk.
ever out in
We didn't even,
Austin, let me know, man. I would love to hang out.
yeah, for sure.